Welcome to Keep What You Earn, a show for entrepreneurs and business owners who want to scale and build enterprise value without making costly mistakes. I'm your host, Shannon. I'm a CFO and CPA who left a career serving Fortune 50 companies in Wall Street to help business owners just like you make life-changing wealth with your business. These episodes are meant to be super tactical and actionable, but please remember, consult your own financial professional before you implement anything you learn in this podcast. Now, if you'd be interested in working with us to do so, check out the show notes for more information about our company, Keep What You Earn Co. All right, let's start the show. You may not realize it, but there are a lot of things that business owners do that actually sabotage their own cash flow. And even though cash flow may be a top priority for you, there are things, little actions, little behaviors that you're doing that could actually contradict that goal without you even realizing it. So just to recap, cash flow, which is different than profit, cash flow is really the metabolism of your money. It is driven by the velocity of how your money moves and timing. So if you want to think of profit like what's left over after expenses from what you earn, cash flow is basically based on the timing of when you make money coming in, make deposits, or you pay money going out, how much money is flowing on a net basis. So are you bringing in more than you're spending from the standpoint of your timing and your cash? Now, cash flow also takes into account things like your loan payments, credit card payments, distributions from your business bank account, and your contributions. It takes into account all of these other factors other than what is actually showing up on your P&L. So when it comes to cash flow, the name of the game is pay things slower and collect things faster. That's really the fundamentals of it. And what you may be doing in the name of other habits or good behavior is you could be sabotaging this cash flow by doing things that maybe you were taught to do or that are more in your nature. Things like paying off your credit cards too early. I know several entrepreneurs who are guilty of this. Now, a lot of credit card companies offer you benefits for paying your credit cards early. And for that, I say, okay, now if the money is worth the reward as opposed to the risk. So what you don't realize is when you are paying credit card balances off early, what you're doing is you're not actually saving any money in interest. Now, when I mean credit card balances too early, I mean before your statement due date. Let's say you're running an average balance of $10,000 in your credit card account, every month. If you're paying those off before the statement even settles, if you're paying those off as you go, there's no real benefit to you to paying early. Now, paying on your statement date, great. Paying a little bit early to earn some type of early pay discount, also great if you have the cash flow. This is the biggest thing. Is a lot of people are paying off these credit cards and not realizing that they have more time to do it and that they're just doing it early. And there's nothing wrong with waiting until the day it's due. And I realize that it can be unsettling to some people to have a certain amount of debt in the bank, that makes them uncomfortable on their balance sheet to look at that. But I'm telling you, you have to start getting used to having debt because debt is healthy for your business. Now, it's when you have excessive debt that you can't pay back that it gets a little bit more dangerous. But as long as you have enough money, enough cash in the bank account to cover this balance, it really won't benefit you to pay today versus next week, especially if you have employees who have to run payroll. So this is where we get into prioritizing. So a lot of times what can happen is you don't realize how your money is moving and you pay off a credit card balance that you see because you see it growing and climbing. But what you fail to realize is that next week is a payroll week. And if you're not collecting enough money this week and you're choosing to spend money on, say, the credit card balance, you could be in trouble where you can't make payroll. So you have to be planning and timing all of these things and know that what your priorities are matter. Hey there, are you on LinkedIn? I love connecting with listeners and other professionals and business owners on that platform. I gotta say, I'm really enjoying it. So if we're not already connected, make sure you send me a connection request after this episode. So if employee payroll is your top priority, which I think it should be, because here's the thing, you don't make payroll, that's a huge freaking deal. That's going to damage the faith that your employees have in your company. It's going to make them worry. It's going to harm morale versus if you go an extra week without paying your credit card. Yes, you will incur some interest. Yes, this is not ideal, but I'll tell you, I can pretty much guarantee you that waiting a week to pay your credit card is going to be a lot less impactful than waiting a week to pay your employees. And you have to really be mindful of what your priorities are and what has to happen first. And then the last thing I'm going to add to this is really having a lax collection process. I can't tell you how many business owners refuse to ask for their money. And we even phrase it as ask for your money, but it's not even a question. It's not even asking. Somebody has agreed to engage you or agreed to buy your thing. You've sent an invoice or you've sent a link to pay. They haven't paid yet. And especially if you're sending an invoice and you are, giving them 30 days to pay, 15 days to pay, or even if it's due on receipt, you should have no problem reaching out to them and saying, hey, this is overdue. Please let us know how you plan to pay. And you have to have policies and procedures, and you have to make your clients aware of that, where they are actually enforceable. And you can have late penalties. You can have, even what I call, instead of late penalties, I actually like to phrase it as, if you pay within 15 days on an invoice, we'll give you a discount. Because I would rather have, a little bit less money in my control sooner than wait, especially if that client doesn't always pay on time. I would give them the option of, if you pay within 15 days instead of, say, a net 30 standard, if you're going to pay within 15 days, you get a 10% discount or something. And that's huge, because that actually is money saved, because you are spending money through your time and through your employees' time in the follow-ups. And that's the important part to realize, is that you're spending money every time you're following up with these people, and you have to wait for that money to come in. The whole name of the game is get that money in your control faster. Okay. And then the last thing that people do to sabotage their own cash flow, believe it or not, is pay their estimated income taxes. Now, I'm going against basically every accountant's advice ever by telling you to hold off on paying those estimated payments. I just want you to think twice before paying them. For a lot of people, the estimated payments are great because they increase discipline. They enable you to pay less over time in smaller installments, and that's great. But for many entrepreneurs, many business owners who haven't quite gotten into a rhythm of knowing how much they're going to owe yet, and they're using these estimates as a guideline, understand that these estimated tax payments are based on last year's performance, last year's income. So if you believe that your income this year is going to deviate from that, then your approach to your estimates should also deviate. I see a lot of business owners tying up their cash flow by paying these estimated payments in full every quarter without realizing that their actual business performance isn't really matching that of last year. And they're tying up that cash flow, paying the government what I would consider early, prepaying their estimates. Now, if you do not pay these estimates, you do get hit with an underpayment penalty. But here's the thing. You get hit with the underpayment penalty if you owe more, and you'll get hit with the penalty, which is a small percentage of what you owe. Now, for a lot of business owners, and for most of the clients I work with, they would rather have an extra 6, 9, even 3 months of control over that cash, especially if we're talking about 5 or 6 figure payments. They would rather have control over that to be able to hire somebody. Think about this. If you have about $40,000 in estimated payments to make on Q1 or Q2, that's, the rest of a year of a salary of somebody making $80,000 a year. You can hire someone at $80,000 a year in June and pay them that 40. And then you can make enough money to cover the taxes and then some, and then the penalties too. And you can make enough in interest to also help cover that. I'm a firm believer that a business owner is really a resource allocator whose job it is to figure out where's the money best utilized and in whose hands. And very seldom do I personally believe that the money is better off in the government's hands a lot faster, most of the time. And in that way, I would say, just think twice about it. Make sure that this is part of your prioritization. If you have sufficient cash flow, if you have healthy cash flow and you can afford to pay those estimates, you absolutely should. But if you have to make a choice here between hiring an employee or making payroll or paying off debt that's skyrocketing interest at like a 25% rate, even 10%, I would rather take those solid decisions in my business over prepaying estimates. And I just, like I said, not anti-estimates, but I am pro really customizing your approach and pro thinking about what's best for you. Because in your early years, sometimes just having that cash a little bit longer is going to serve you. And you could be sabotaging your own cash flow without even realizing it by doing that. So So profitability is one thing, but cash flow is what truly keeps your business running smoothly. It's not just about how much you make, it's about how much you can actually use to sustain and grow and maintain that cash in your control. When you book a power session with me, we can take a look at your payment cycles, your transaction timing, and your personal cash needs to make sure you're staying ahead of the curve. Managing cash flow is a constant process, but one of the most important pieces of the puzzle for a successful business. Find out more information about a power session with me to do your cash flow forecast in the show notes.